Look around the Gulf today, and you'll see nations armed with immense sovereign wealth, funding sprawling, uninterrupted megaprojects. But cross the causeway into Bahrain, the region's smallest economy, and you find a very different and much harsher fiscal reality. This chart shows the breakdown of Bahrain's economic output. It highlights a massive achievement, a post-oil economy where 85% of the country's gross domestic product is generated entirely outside the oil sector. Yet, as you can see by this rising trendline, despite that thriving commercial sector, the government is drowning in debt. The state's debt-to-GDP ratio is currently hurtling toward 140%. The math driving this crisis comes down to a single metric, the fiscal break-even price. To balance its budget without taking on new loans, Bahrain requires global oil prices to hit an astronomical $130 per barrel. With actual market prices hovering around $70, the resulting structural deficit is immediate, wide, and persistent, which leaves us with a central mathematical contradiction. We need to understand how a country can successfully build a thriving commercial economy, yet completely fail to construct a sustainable government budget. For decades, Bahrain acted as the pioneer of Gulf diversification. The state built competitive financial and logistics sectors by absorbing the heavy infrastructure costs and offering a completely tax-free regime to attract foreign investors. The government paid to maintain the commercial sandbox, but it collected almost zero direct revenue from the wealth generated inside it. This diagram illustrates the resulting imbalance. Because of this zero-tax strategy, the state still relies on a single narrow oil pipeline to fund over 60% of its total government revenue. Relying so heavily on a single income stream leaves the national budget highly exposed to unexpected domestic or geopolitical disruptions. When an attack severely disrupted energy production at the Citra refinery, the government had no alternative revenue buffer to fall back on. The loss was so immediate that the IMF had to project a sudden economic contraction for the entire country. Without the windfall of high global oil prices to cover the state's generous subsidies, the country simply cannot afford the commercial hub it built. Bahrain has navigated these deficits before. In 2018, neighbors like Saudi Arabia and the UAE stepped in with a $10 billion financial safety net to stabilize the economy. But the era of the regional blank check is over. Those wealthier neighbors are now aggressively deploying their own capital to fund expensive domestic transitions, like Saudi Arabia's Vision 2030. Financial assistance now comes with heavy conditions. Regional backers expect strict domestic fiscal discipline and aggressive concrete tax reforms. In response, Bahrain is planning a drastic domestic pivot. As shown on this timeline, the country has proposed legislation to enforce a 10% corporate income tax by 2027 to achieve long-term solvency. This legislation actively dismantles the core identity Bahrain spent decades cultivating as the tax-free gateway to the Gulf. To appease its regional backers and avoid bankruptcy, Bahrain has to eliminate its primary competitive advantage in the global market. The investor risk here is severe. If corporate taxes push operating costs too high, multinational capital can easily relocate to neighboring capitals. Saudi Arabia and the UAE can successfully enforce corporate taxes because they offer massive domestic markets and lucrative government contracts that keep investors anchored. Bahrain lacks that massive domestic scale. Tax optimization is dead. Companies will now have to find genuine, market-driven value to justify operating there. To create that value, the government is completely reprioritizing its Economic Vision 2030. They are moving away from prestige real estate projects and redirecting capital toward infrastructure that yields direct, immediate economic returns. Their specific survival strategy involves building deep expertise in open banking and cross-border digital payments. They are betting they can compete on regulatory quality and nimbleness rather than market size. Bahrain can no longer afford to be the cheapest room in the Gulf. It has to urgently become the most efficient and well-regulated one to survive the incoming tax hike. This graphic breaks down the global significance of this crisis. Escaping oil reliance requires two distinct steps. The first is diversifying commercial activity. The second, and much harder step, is restructuring state revenue to capture that new wealth. Bahrain is simply the first small petrostate in the region to violently collide with this second step. If Bahrain successfully transitions from an oil-funded tax haven to a self-sustaining fiscal state, it will author the survival manual for the rest of the Middle East. If it fails, it proves that small petrostates without massive sovereign wealth simply cannot survive a low-oil world.